Today, the Governor and the Reserve Board met and they've kept interest rates on hold for the first meeting of 2016. Now that keeps the cash rate at 2%, and we haven't seen a change in that cash rate since May last year. Now the big news of the turn of the calendar year was actually the share market and the jitters that we saw run through those markets. In fact, it was the worst start to a calendar year ever recorded across global equity markets. So we have real concerns out there, and we've got this real high volatility around what's happening in the share market at the moment. And I think that's mainly led by the China story in terms of exactly what's happening in China. Second biggest economy in the world, anticipated to become the biggest economy in the world, but they're just struggling to transition from an exporting nation to basically a consumption nation. So we've seen the government there trying to do a lot to try and curb those jitters. The marketplace, the Shanghai index has been bouncing around, and that's obviously causing a lot of concern and sentiment shift around the general economy. Because when we see markets do that, people become quite reserved and they don't spend as much. So that's what we're basically seeing. And if they're seeing their fortunes being wiped away, that's a real challenge. So it's been a difficult start for January in terms of the share market, and globally, it's been a challenging time for what's been happening out there. So that's probably the negative component. Let's move to local market. And what we have in Australia is really what I would call a steady economy, but sluggish but steady in terms of we're tracking in the right direction. We've got unemployment still under 6%. We've got things happening around consumer spending. Most people reported a fairly positive Christmas and Boxing Day sales period, and we'll see those results coming through shortly. And we've just started to see some early indications in what's happening in the housing market. If we do a quick fly around, we've seen Melbourne do quite well in the January time period. Now, again, small sample because it's not an active time that property is being transacted in the January market, but we've basically seen Melbourne have a positive result. We've seen Sydney have a steady result, and we've seen other markets. Hobart in particular had a very strong January period. Maybe it's people who are holidaying down there that are thinking they can buy a bargain, and certainly from an affordability, Hobart looks very affordable. Canberra, again, a really good result for Canberra. We're starting to see some of that oversupply being absorbed, so Canberra is potentially a market to watch. The interesting, and Brisbane had some positive numbers. Even Perth have had a rolling positive 3 quarters. Darwin, again, sort of still a bit sluggish. So for me, across the nation, I don't think we're going to see the sort of growth levels that we saw in 2014-15 for the Sydney and Melbourne markets. But I'm also not predicting that we're going to see a big correction in those markets. There are going to be markets that I am seriously concerned about, and that is the medium and high-rise apartment market. There's going to be an oversupply in those markets, so I'd be really worried if I was an investor or a buyer in those markets. I don't think values will hold their current levels, but certainly if you've got land and you've got construction or building on that land, 3 and 4 bedroom houses, those types of properties are still in demand. So I suspect we'll see some growth in those areas, especially if the economy continues to move. Now I want to talk also about what's going to happen with interest rates throughout 2016. Now if the world was normal, I suspect we're going to see interest rates remain on hold for a reasonable extended period of time, potentially right through 2016. But here are my 2 caveats. If we see APRA with more market interference and the banks arguing that they need to hold more capital as part of their Basel III requirements, global requirements, then I suspect you may see an out of RBA increase again. So these lenders taking an opportunity to increase their margin as they're getting sluggish business profitability. It's all falling on the residential borrower. So that does worry me a little bit and concern me that we might see interest rates move higher in the residential market space, and that could give the RBA the ability to pull the lever even lower in terms of the cash rate. So if the Reserve Bank is seeing that residential lending is still pushing high and the banks do that out of cycle increase, the Reserve Bank can pull the lever lower, which means that business lending won't be affected, and hopefully we'll see some stimulation inside the business community, which will hopefully generate jobs. And the RBA is really interested in increasing the number of people working and what we call the spare capacity in the labour market. That's what they're looking to do. So all in all, I think it's going to be a softer year. From a yield perspective back in the housing sector, yields have never been lower in terms of rental increases. So we're going to probably see a period, because we've got this, Melbourne, Sydney particularly, where we've seen this really strong growth pattern over the last sort of, well, in some cases 10, 15 years. We've never seen the growth rate in rental going so slow. So once you see the plateauing of value, you start to see those rents rising as well. So a very difficult market for 2016 to be picking the right type of asset. So I would suggest get some professional advice, understand the numbers that they're looking at, days on market, supply is the big conversation, average day discounts, demographics, incomes, those are the types of things that are going to go back to the fundamentals in terms of getting price growth in particular pockets around the Australian market. Thanks for watching.